Welcome, everybody. Thank you for joining us for this new edition of Growth Talks. Thanks for taking the time. I'm Michel. I'll be your host, moderator, maybe even referee if things get heated. I'm an entrepreneur, investor. I've led for about 8 years an ad tech company based in Berlin. And I'm also strategic advisor at Stanena, who's hosting the event today. Before we get started, I just want to cover a few housekeeping items. We have about an hour and a half, which I think is more than enough for us to cover quite a lot of ground. We won't have a Q&A session at the end. Instead, I'd like to invite our audience to ask questions as we go, and I'll try to weave them in as gracefully as possible in the conversation. You have access to two extremely experienced and knowledgeable people, so I want to make sure that you take that opportunity to ask them tough questions. So without further ado, let's get started. Instead of trying to do a formal introduction as if you guys had won the Nobel Prize, I think it might be more interesting to let our guests introduce themselves. So guys, please tell us a bit about yourself, your company, and your experience with startup acquisitions. Andrew, maybe you want to break the ice?
Yeah, sure. First, thanks for inviting me. Excited for this. And Kjael, what's up, man? Good to see you. Brief introduction of myself. My name is Andrew Gazdecki. I've also been an entrepreneur pretty much my whole life, I would say. And then I'm currently the CEO and founder of a company called Acquire.com, where we specifically help startups get acquired. And prior to that, I had 2 businesses of my own acquired. So been on the sell side, been on the buy side, and everything else in between. So super excited for this.
Right on. And good to see you. And this will be fun. And Michel, thank you for having us. Yes, my name's Kjael. Looks like Kjael. And I guess my background can be defined. I've been in SaaS most of my career, mostly in go-to-market roles, go-to-market functions, so sales and marketing leadership. I was a venture-backed operator where I then kind of transitioned into the private equity domain, where I was what is called an operating partner. So a private equity fund would acquire a business and install me as CRO to grow it and help lead the exit. So after participating in the sell side, I decided, okay, I think there's maybe an opportunity. And in all honesty, Acquire.com was a huge motivator for me, because I started to see this entire universe of really durable, healthy SaaS firms that with founders who had bootstrapped them to a certain place and were kind of looking to explore the next chapter in their career. So I was immersed in all these awesome businesses that were for sale. So that was kind of the motivation that I needed to step out on my own. In March of 2023, we acquired our first firm, which is a business management suite for creatives. So think event-based creatives, wedding photographers, stuff like that. It's really a CRM at its root. And we've been operating and doing our thing for a year and a few months. And I'm currently raising for our second acquisition. And the intent is to buy and build a portfolio of healthy, profitable, very niche vertical SaaS businesses, all B2B.
Fantastic. We will probably be jumping from one thing to another, but I want to start. I don't know if you guys know the show Silicon Valley. There's a pretty funny scene where they talk about their revenue model, and there's one of the guys says, "Why would you go after revenue? If you show revenue, people will ask how much, and it will never be enough. But if you have no revenue, you can say you're pre-revenue. You're a potential pure play. It's not about how much you earn. It's about what you're worth and who's worth the most. Companies that lose money. We live in a world with higher interest rates and where cheap money is pretty much gone. So I'm curious to start by asking you what make a startup attractive in today's world.
You want to go first, Kjael?
Sure. I have tons of thoughts around this. I actually did a few blog posts because I think ARR multiples are generally convention, and they're useful because, a company that's doing $50 million in ARR, it kind of has certain signals in that scale, right? Size of team, number of products, market penetration, number of customers, et cetera. So ARR is a useful way to kind of put a business into a certain cohort and make some assumptions around the attributes of that business. And so that's why you see it, so predominantly in venture investing. That's why you see it in public market investing. And in our world, or I guess the venture model is how fast is ARR growing, period. What's ARR now and how fast is it growing? And we'll worry about profitability in the future. So it's kind of this growth at all costs, which was something that kind of caused me to leave the venture model. But obviously in acquisition entrepreneurship, ARR doesn't pay the bills, profit pays your bills. So there's, I guess, a growing sense that EBITDA, net operating income, however you want to think about it, but profit margin is the real way to value how healthy and productive a business is. So I think ARR is useful to kind of figure out which ballpark you're in, but then you want to understand profit margin as a search entrepreneur, because that's the stuff that you can use to fuel growth. That's the stuff that you can draw an income from to cover your bills. So unfortunately, it's kind of two-pronged, but I would say the days of just looking at ARR, and especially I don't think ever in our category, like if you extract out to like acquisition entrepreneurs, it's always been about seller discretionary earnings, which is kind of a different flavor of profit. But profit margin is the name of the game in the search acquisition and kind of, the path I chose, which is obviously the arena that Andrew caters to.
What about you, Andrew? I think, when you sold Biz Apps, what was the profitability one of the things that played a role in your evaluation, or it was a different time?
Yeah, I mean, gosh, it feels like a decade ago. It was actually 6 years ago I sold that company. At the time, we were around break even. We were a little profitable, but not by much. And when I was running the business, that was by design. So we were essentially reinvesting everything back into growth to continue growing the business. But we could be profitable if we pulled back on that spend. So yes and no. And for more context, I sold to a private equity firm. And at the time, profitability wasn't really that big of a conversation as compared to it is now, as an example. I think every acquisition that I'm a part of now, profitability, like Kjael was mentioning, is kind of the first number. I haven't seen a company losing money get acquired in a while, unless your growth rate is astronomical, and that's kind of masking the reason for any sort of sustainable, profitable growth. So yeah, I mean, I think Kjael kind of hit it on the head. Profitability is kind of the world that we've shifted to, and this is even a change from just 2 to 3 years ago when you could get by with a break-even SaaS business, growing even modestly. Let's call it, low double digits every single year. But now when I speak with buyers, they're predominantly looking for, ideally profitable businesses, and that's how they're being valued. And so typically what I'll see is profitability is the first number and a multiple added onto that. But there are some cases where, it makes sense to use top line revenue as the number to put a multiple on. But it's going to be heavily dependent on the buyer. Is it a strategic buyer or a financial buyer? How fast are you growing? Are you in a huge market where there's a potential land grab going on? But for all intents and purposes, I'll just use the averages. So, just a typical SaaS business, let's say it hasn't raised, venture capital, and it's in a niche market and it's really kind of grown into that. Maybe it's doing a couple million a year, which may not seem like, the next Google acquisition, but it's still a very meaningful acquisition. And almost always those acquisitions today are seeing, profit being the first item that's being looked at. How healthy is the growth? How healthy is the customer acquisition? How sustainable is this business? Because no one wants to acquire a business and have to keep, funding the business just to keep it alive. They want to at least see a line to profitability or path to profitability. So to answer your question directly, yeah, I mean, profitability has been a huge shift, and I saw that shift happening probably about 2 years ago. So it's relatively new. But yeah, both are important.
And I guess just to add that too, I think what makes an attractive business, the first thing you need to be super clear on is what game are you playing? Are you playing venture capital, where the hope is to invest in something that has an opportunity to create a huge 100x outcome? And it's like, hey, I'm going to make 10 investments. 2 are going to generate that extraordinary outcome that will return the fund in happy days. Or are you playing the private equity game, which is usually to take high growth and then transition it to a profit engine? Or in our game, search entrepreneurship, the assumption is that you're going to be operating these businesses and that's going to be your livelihood. So I guess if you extract beyond that or abstract beyond that, there's got to be a growth story or a profit story. And that's where you start to see the emergence of metrics like Rule of 40. which is simply put, your growth rate and your profit margin need to add to 40. So you can grow at 20% and be 20% profitable. You can grow at 40% and be 0% profitable, but there's got to be a growth or a profit story, really, regardless of the game you're playing.
Yeah, I really like that point, Kjael, in terms of knowing the game you're playing is huge, especially when you're in venture. I think unfortunately see a lot of startups that, raise venture capital and, they enter a market and kind of top out over a certain point. Those are still great businesses, but, if you find yourself in that boat, it could be a good idea to think about an exit. And then, Kjael, I think you just described exactly my first acquisition. We were acquired by a private equity firm. We were in modest growth mode, but not profitable. And they acquired the business to essentially flip it to a profitability model. And then we work with a lot of individual acquirers, also strategics and private equity. But as the asset gets, to a certain size, you kind of need it to be profitable for an acquisition. So I thought those were great buckets, Kjael.
Yeah, and I guess one final thought on this too is, like, again, for the operators or the founders that are in the audience, like, if you assume who is your buyer, the majority, especially in kind of the micro SaaS category, are going to be using debt financing, and they need profit from the business to pay the loan, the debt, what is called debt service. So if you take out a loan, you're going to have to pay off the loan with the cash flows from the business. So there has to be some profitability. So in a lot of ways, your profit margin is the number one thing that goes on to influence valuation, because that number tells you how much debt the buyer can take on to make the acquisition. But that's, again, assuming a mid-market person like me using the use debt to make the acquisition, not a venture investor.
Can I have one more thing, Michael? Or are we spending way too much time on the
It's a great question. Yeah. This could be the whole conversation.
Kjael, I love the points you're bringing up. I mean, one other maybe point to bring up is, as you think about acquisitions, and I'll speak to the founders too, and the crowd is, it's best if you can figure out how a buyer thinks. So Kjael just, hit another great point on the head is, a lot of buyers today will use some sort of financing, or when they acquire the business, they're obviously looking for, return on their investment. So having your business as a profitable one will increase your buyer pool immensely, because the line to return on investment is so much clearer when it's profitable. And it's not a situation where, you got to sell them on some story, or, hey, if you just do X, Y, and Z, you can double revenue. That usually leads to a question of, well, why haven't you done that? So in today's market, definitely when you think about the types of buyers, you're probably going to land with, typically a financial buyer is what I like to say. I like to say if your enterprise values, let's call it under 20 million. And Kjael, I'd love your opinion on this too. But I'd put your odds of being acquired by a financial buyer 40%, a strategic buyer 10%, and then ironically, an individual buyer at another 40%. I think that's been a huge emergence. And when I say individual buyer, I mean ex-operators, ex-founders, VPs at a company that want to be CEO of a small tech firm. And that could be a great pool as well. And I think that's a new one that a lot of founders don't necessarily think of. But to Kjael's point, that profitability margin is what a lot of those operators are going to be looking for immediately. So the more that you can understand them and how they look at businesses and review them, the more you can kind of reverse engineer your way to a potential exit.
Yeah, I totally agree. And I would just say that, like, both are things. It's like, well, you could do this. And anytime as a seller, you say you could do this, to expect the buyer to tear that to pieces. Because it's your point, Andrew. It's like, well, why haven't you done it? Or what are kind of the assumptions that underpin that point of view? And I would say maintaining extraordinary growth rates is way more difficult than optimizing a cost model, where it's like, hey, I'm not sure if we can continue this 20% year over year growth, but I do know that we can reduce costs by 10 to 20%. The only challenge is that reducing costs there's a finite pool to work from. Like, you can only reduce costs to a certain point. So it's basically a lever that you can pull once, and then after that, it's gone. But I actually did a blog post on this once upon a time for people that want to dive a little bit deeper. That was like buyer profiles and micro SaaS. And I totally align that. I think as a rule of thumb, traditional private equity players in like lower middle market buyouts, will just, apologies for the jargon ahead of time, but they typically start at 5 million in ARR, and some will reach down into 3 million. But below that number, and then the enterprise value might be who knows what. But if you just look at ARR at 3 million, it's like, okay, we have like institutional professional funds that are making acquisitions here. Below that, you can assume a less kind of institutional type acquirer. And one general kind of rule of thumb, like if you talk to a savvy alternative investment allocator of capital, usually the benchmark is a 3-year return. So, or 3-year payback period. So it's like, okay, if I buy this business, it's generating 200K in profit. I need to get paid back in 3 years. Then you can assume the valuation, in this case, just round numbers, is 600K. So it's like, cool, I'm going to pay you 600K, which is a huge, I guess, departure from traditional ARR or SaaS models. Cause it's like, whoa, the valuation is less than ARR, like less than a 1x ARR. But that's just back to the buyer profile. It's like, I'm going to lay out this cash and this is meant to generate an investment. I need to break even in 3 years. That's a good, just like very general rule of thumb.
One of the things that you said, Andrew, in the interview we did, I think it was last year, you mentioned that when you went through the acquisition, the exit process, some of your friends reached out to you, and it was a bit as if you had, been through, I don't know, you had traveled through time and, came back alive. Like it was a very obscure type of process back then. So I want to make sure that, for our audience who've not been through it, that, we try to simplify and be as concrete as possible. And I think what you just said, Kjael, is kind of a good segue into this. If I'm thinking about selling, and we try to, reduce it to the top 3, top 5 things I should be thinking about, what's the best way for me to prepare my startup for an exit? Whether it's on revenue, whether it's on due diligence prep, or on cost.
Andrew, this one's on the batting tee, buddy. Swing for the fences.
Yeah, great question. This one can be taken a number of different ways, but at the top, I'll say you want to absolutely plan for an acquisition in advance. So if you're thinking about an exit, I hope you are, because at some point your business could have an acquirer come to you, or you might want to go to market, whatever it may be. You want to be prepared in advance. So just getting your house in order, I think, is probably the first thing that comes to mind. And I remember I got a piece of advice from a mentor that I had with my first business early on. And the advice was simple. It was just hire a VP of finance. And I would always ask, like, why? We have a great outsourced accountant. And he just gave me some great advice at the time, which was, it'll buy you good faith with an acquirer. And given that we had sold to a private equity firm, a financial buyer, lots of financial models were requested, lots of different spreadsheets. I'm not a financial whiz myself, so that was hugely helpful when that time came. So just having a clean P&L, that's probably the first place I would start. Knowing, how your business is trending in terms of growth, profitability. And for me personally, I had actually hired an investment bank in, I think it was 2000, let's call it like 15 or 16. We had met with a number of different buyers and ended up getting 2 kind of like verbal offers. But at the time I had more gas in the tank, so I kept going. But my point is I learned a lot about how buyers were thinking about the business. I got a lot of great feedback on what they didn't like about the business. And for more context, the business that I initially sold was a drag and drop mobile app platform that enabled small businesses to easily create mobile app. And I learned that basically what we were doing, the company was based in San Francisco. We were pushing for growth, and we were kind of, not operating very efficiently. So we had lots of areas where, we were spending money inefficiently. There wasn't a clear return on investment. And so what I actually did was move the company down to San Diego, where we really started focusing on, if we put $1 here, we want to make sure we're getting, 3 back. So built out my executive team, and that was kind of where, we really prepared the company for an acquisition. So to give more, kind of personal experience, I spent like 2 years preparing the business for an acquisition. That meant, readjusting the team, getting the right people in place, really thinking about, how buyers were looking at the business, and basically how to make it appealing to both strategics and also financial buyers. So going back to my first recommendation, prepare in advance and then understand, what type of buyer is most likely to buy your business. Kjael was mentioning, typically for, institutional private equity firm, they aren't typically going to go below 5 million. So if you're above 5 million, that's where you probably want to sell to. You want to sell to, a large private equity firm. And these are firms that really do actively acquire SaaS businesses, or really any type of business every week, every month. So that could be a great avenue to sell your business, or a strategic buyer as well. But to facilitate those acquisitions, you want to really build that relationship really, really far out. Other things is, just ensuring that you don't have any sort of risk within your business. So one risk that I had in my business was I was way too dependent. Like, you needed me to do everything in the business. And so when I, moved the company down to San Diego, we did that because I wasn't able to hire a good management team in San Francisco. Salaries were too high. But the reason I did that was so there wasn't so much dependence on me as CEO, where I could take a week off and stuff like that. So putting that into context for maybe a different business, make yourself the most useless person in the business to some extent, because you might not be needed when you're acquired. And that's kind of something that a lot of buyers want to see is, they don't want to give you a bunch of money and then have to worry about you staying around or figuring out how everything's going to work. So figuring out a way to make the business less reliable on you and really delegate, and that's just good business. That's just how you build a great business, regardless of if you're going to sell it. So don't be afraid to delegate. Don't be afraid to build out a team that can ideally take over departments better than you can. And then I guess the third point, or the third piece of advice is get to know buyers in advance. So build those relationships early. So when it's time to go to market, you're the one that can control the process. You're the one that can ideally bring multiple buyers to the table, because it's great to have an acquirer come to you. But if that's your strategy, I wouldn't necessarily bank on it. There's a quote that is commonly thrown around that I like to disagree with, which is great businesses are bought, not sold. And I think a lot of businesses are more often than not sold and not bought. What I mean by that is the owner of the business actively prepares their business, has it ready to be acquired, and then goes out to buyers and says, hey, I'm thinking about selling my business. We've spoken a number of times over the past year, or maybe over the past few months. And, I'd like to see if there's any interest. And what that does is you bring multiple buyers to the table. And when you bring multiple buyers to the table, you can leverage them against each other to get multiple offers. And that can help ensure that you maximize your exit rather than just getting one offer from one buyer. You want to create a competitive process. Kind of a lot, but I hope that's helpful.
Yeah, Kjael, I was gonna ask, because we've talked about this and also in a podcast episode, and I think you for your first acquisition you probably analyzed like something like 200 companies or more. And I know you have a pretty structured framework to go through the deal flow. When you are analyzing, looking into a new acquisition target, what are the key things that make you click and say, well, these are ready to go? Or I guess sometimes it's a bit like when you buy a house where you have, it looks good, land looks good, but you'll have to renovate the whole thing. Whereas sometimes it's more of a, turnkey type of solution. So what's your approach?
Yeah. So, and I guess just as an extension of some of Andrew's commentary, and I totally agree with all that. And I guess the assumption there was his business was at a certain threshold, right? So professionalizing the team, updating a lot of stuff, but there's, I guess for those that want to go a little bit deeper, like just put yourself in the shoes of the buyer. So if you just do a quick ChatGPT conversation, like what do private equity firms typically do diligence on, right? And they're like, okay, well, they want to, I guess, validate the quality of the revenue. They want to look at your customer contracts, your employment contracts. They want to, I guess, look into the code base and execute some technical diligence. And so I've always found, and I guess that'll kind of lead you to this place where you'll need to establish a data room, which is basically one central repository for all that information. And as savvy operators, you essentially want a company wiki, like an internal data or internal location that's, digital, obviously cloud-based, that the whole business can go to answer questions, to find useful content that way. So I guess the best way to prepare in advance is to organize all your stuff by putting it in one place. And chances are that you have a lot of the things that already exist that would go into a data room. It's just kind of an organization activity. And what's so beautiful about the era we live in, and this is a shout out to acquire.com, is, conventional data rooms are like, oh, I need to export our P&L and put it over here. And oh gosh, it's been 2 months since I updated the P&L. Nowadays, the system of record, or the systems of record, are the data room. So just embed a dashboard, or just embed a link to ProfitWell, which shows your revenues, which has all these different metrics. Embed an API to your QuickBooks so you can look at the P&L. But I'm a big advocate of, we don't rise to the level of our goals, we fall to the level of our systems. And chances are, if you're a SaaS or, I guess an e-commerce operator, you have technology doing a lot of the heavy lifting. So how do you just provide that visibility to potential buyers? Because that's, I guess, now to answer your question more directly, right? Like, I can't do anything if I can't see anything. So you have to get your house in order to, at least to a degree, that somebody, a third party, can validate your claims as to the business performance. And so it's mostly about revenue. It's about cost structure. It's about web traffic. It's about different things like that. But once those things are there, I mean, I think to keep it very simple, so we focus on niche verticals. So that's where it gets a little bit subjective, because it's like, well, what is a niche vertical? Is that like a certain point in a specific workflow of a huge market, or is it more about going after the actual industry size? So there's some subjectivity that we try to remove by very, I guess, concretely defining what it means. And we have very structured definitions that we've had to work towards. But when I look for a business, it's like, okay, do I see this playing? And I'm like, I guess if I was to summarize it, like, our strategy is blue ocean, right? So it's like, hey, if we stay below $3 million in ARR, then we know we're not going to be competing with private equity players, because as Andrew just commented, that's more likely to be an auction environment where you have multiple buyers at the table. They bid up the price, and then all of a sudden it's like, oh my gosh, if we buy this business at this value, we can't make it more valuable. So there's no chance we're going to generate a turn. So staying below that $3 million ARR threshold helps us avoid competition from the private equity players. And then by focusing on very niche verticals, we avoid competition from the venture-backed players, because they have to go after huge markets for even a chance to hit that 100x outcome. So we try to play in very small little corners of the universe and play at thresholds with businesses that are below that revenue threshold, so we avoid private equity. So if I look at that, it's really a function of where's your ARR, what's your profit, and then, I guess, to speak again at the most high level, like, we're not playing the startup game. So the assumption is that we're buying product market fit. And there's a ton of flavors of definition of product market fit, and it's kind of a dark art. So I don't want to take us down that rabbit hole, but one simple way to measure it is user retention. And then you look at base rates. And I guess that would be an interesting piece of advice too for prospective sellers is, once you have your house in order, then understand your performance on a relative basis. So, hey, okay, our growth is really interesting for firms that are generating this much ARR. Our profit margin is terrible for firms that are generating this much ARR that are listed. And there's great benchmarks. Obviously, marketplaces like acquire.com have really good data on that stuff. Highly encourage you to read that stuff. So to answer your question for us, I mean, we have a 55-point diligence checklist, and it basically opens up as we get further into the deal. So at the beginning, it's like, okay, we're just screening this from headline information that's public information. And the benefit of working with a marketplace is you get your hands on revenue, profit margin, a lot of this data. Other than that, you're just, approaching private businesses based on some assumptions. Like, they've only got 10 employees. They can't be generating more than 5 million in ARR. But those assumptions will get you in trouble, especially today with all the operating leverage that's around with generative AI and inference-based models, where one person can punch like 5. So for us, it's really about user retention. I think a lot about founder market fit. So I want to see someone who's like, I built this thing to fix my own problem because I operated in the market for 5 years. Love that story, because they have such deep kind of user empathy or persona empathy. But it's usually a mix of growth rate, profitability, user retention, and then some of the more subjective elements around whether it fits in that kind of blue ocean that we're trying to go after.
I have been on the, I've been through acquisitions on the buyer side a couple of times. And then I've heard stories on the other side where, the acquirer would ask for documentations, and then the seller would actually, create them as, as they were requested. So if we summarize a bit what you both just said, Andrew, you talked about having a clean P&L, making sure that, you have the right data accessible, ideally digitally. Where do you see the big messes in startups? Usually they're probably, you've talked about employer contracts, Kjael. Like, what are the areas where most startup kind of suck, or they could do better?
Yeah, quick thoughts on that one. Like, usually it's any kind of like weird SaaS-y, and obviously my context is pure play SaaS, but like, once you start asking about weird metrics, like, okay, what's your LTV? What's your, what does retention look like across cohorts? Folks are like, oh boy, I need to run calculations. And then as the buyer, you have to start to, I guess, assign a discount to those requests that are being created in real time. Because it's like, oh boy, they're making this for the first time. Maybe they made a mistake. And so one very easy recommendation is to use a free tool like Profitwell. which will just pipe in, and assuming that all of your revenues are being billed through Stripe, or that there isn't kind of a lot of variance in how you're actually bringing revenue into the business, you can lay on an analytics tool where it'll give you, hey, here's cohort analysis, here's all this stuff. And better yet, you can embed that stuff in a Notion company wiki. So, you don't have to answer those questions. You can be like, here you go. But I've seen most sellers getting hung up when you start to ask weird SaaS calculations and metrics, because maybe their P&L is in order, but they're stepping into Stripe and exporting and trying to manipulate that data manually. And that all just creates a room to hit an extra zero on accident, or, something like that. But so I didn't mean to jump in on that one, Andrew.
No, I would probably say the exact same thing. Data is definitely something I see time and time again. And I ran into it initially in terms of the acquisition I was just describing, where, I hired someone to help me like with the data exports that Kjael is mentioning. And I constantly see it even today, even with the tools that are available. Some startups just can't get data presented accurately to buyers, and it's frustrating. And then it definitely leads to, a lack of confidence. Also, I typically think of startups in like 3 buckets in terms of size. Like initially you have that's called the solopreneur. So that's where if you're going to buy this startup, let's say it's under, I don't know, 2 million in total enterprise value. So maybe it's making, $500,000 a year, $1 million a year, something like that. And if you get a company of that size, you're going to have process issues. You're going to have potentially code issues. Again, it's just 2 people running the business, dependency issues. And then as the company gets bigger, typically you'll start to see a small team emerge. So maybe they'll have some contractors. Maybe that business grows to up to, let's call it 7 million enterprise value. And then once you get beyond that, that's where you usually will see a management team in place with a team below it. So each one of those buckets have their own unique challenges. But typically it all starts with, do they have, clean data? Because without that, that's usually a showstopper for most buyers. Because if they can't understand the health of the business, then the owners of the business don't understand the health. And that just makes everything that much more difficult for a buyer.
Yeah, that whole data room exercise also is a very good way to expose your blind spots, where it's like, oh my God, like I don't even know where our, contractor agreements are. Do we have agreements with our contractors? Because you can also assume that, well, I don't want to take us down that route, but for the audience, you want to understand the distinction between an asset purchase and a stock purchase. So that's something to just kind of research on your own. But in the other piece too, to your comment, Michel, is if you find yourself manually pulling something together, something is wrong. So that, I would probably, if you get a request from a buyer and you're like, we don't have that, or I'm going to have to manually pull that together, that's an opportunity to say, okay, well, how do we systematize that? How do we create that? Because it's probably something that you want real-time visibility into as an operator. So that's kind of an opportunity to say, okay, we can professionalize this part of the business so that we have real-time access to that. Maybe we should look at that once a month or once a quarter. Why would an investor care about that? And that's just back to putting yourself in their shoes.
Yeah, I love just to give Kjael kudos again. The data room exercise is huge. That's something that I wish I did. I remember when we got our first data room request, I had to put it together all on the spot, and it was a big one. And having that just ahead of time. The one caveat I'll say, Kjael, and I don't know how much you'll agree with this, but different buyers are going to ask for different things. I was asked like, have I made like political contributions to like just weird stuff? So, but a data room is a really great exercise to understand how organized are you. Other examples I was asked to share, and this touches on the other point you brought up, Kjael, where some things are going to be more important than in, let's say, a stock sale versus an asset sale. I did a stock sale. So I had to upload every NDA I signed, every employee contract with or not at the company anymore, like an extreme amount of just pretty much everything any PDF I ever downloaded. And so just having all that in a central place can be hugely beneficial to you. Again, even if you're not going to sell. And the reason I bring that up again is the best businesses to buy are typically the ones that, you want to keep. And so the more you can be organized and understand how your business is doing, how does it work? You're able to operate it without you. You have a central repository to onboard new employees quickly. That's a great business, and that's one that's definitely going to get a lot of buyers excited about.
Yeah, totally. And I guess one comment there too is because as sellers, you're qualifying as well. So like you want to introduce little synthetic scenarios that help you vet, okay, how polished or how efficient is this buyer? And if you start to see and I guess the thing too is like with diligence, it's like pulling on a thread. So expect that if they ask a question about something, no matter how you answer it, there are going to be follow-on questions. But what you don't want is death by 1,000 paper cuts, where it's like, well, what about this? Well, what about that? Well, what about this? And all the while you're just reactive. So I would highly encourage, if you're engaging with a seller as a qualification exercise, it's like, please give us kind of your first wave of pointed questions. And it should be either a question that you need to articulate and provide some voiceover, but most of the time it's going to be a reference or material request. So let me see this thing that I can look at to interpret this area. And then once they've had time to digest that, they might come back with questions. But time kills all deals. And so if you're on the sell side and you're like, I'm selling my business, I would encourage you to say, okay, like I'd like to understand what your first wave of questions are. Like, what are the areas that you're going to be leaning in? Where should I expect questions? And then what is a typical timeline? What are the milestones in an acquisition process? Like the more polished the buyer is in providing that, like, hey, here's our turnkey short list of items. We'll work through these as we move in deeper to diligence. Here's a spreadsheet or an area where we can both collaborate digitally so we don't have to go back and forth in emails. And then to Andrew's comment, like you probably want your data room to address like the 70% of surface area that every human under the sun is going to lean into, and then leave yourself some variability for the 30% where it's going to be totally dependent on the buyer. Like, cause they might have experience in this one area. So they're going to lean super hard into go-to-market motion and acquisition channels and what that looks like. Might be a more technical buyer and they're like, I want to see the repo and start looking at the code immediately. And that's the other piece too, is like, you got to get comfortable letting them into your house and like not only letting them into your house, but like looking under the bed, pulling weird drawers open. Like you got to be ready to kind of show all, and then just come into that with like, this is all good. This is how we do this. I need to, be prepared to be pretty exposed here. Anything you hold back, said another way, anything that you resist is a bad signal to the buyer. Be like, well, why can't we look at this? And then all of a sudden red flags and spider senses start tingling.
Yeah, that's interesting because from a seller's perspective, you, especially if you're not experienced at the beginning, like you want to keep your cards close to you, and any questions or them trying to open weird drawers, I'm assuming can feel a bit worrying. So I don't know, Andrew. I remember your first exit. You mentioned two things. The two things I want to cover. The first thing is the actual process. Andrew, you said if you have one buyer, you have no buyer, right? So how do you try to take control or at least line up a couple of them? And then the other thing is there's a big, I guess, trust issue. When you're selling something, especially if it's your baby, you build it up yourself. How do you kind of navigate that fine line, between being open and transparent, but at the same time making sure you're not giving up, information that could, be used against you in negotiation? Maybe Andrew.
All right. So 2 questions. So the process of selling your startup and then how you deal with trust issues as a founder. Okay. So the process is probably something that most founders have no idea how to run correctly, at least from my experience or what I've seen with other founders. But just like when you're raising venture capital, you want to control specifically the timeline. So what I mean by that is when you talk with buyers, you want to talk to all of them at once, especially if you're going to market and you're trying to create a competitive process. So I'll give you an example. Let's say you're trying to sell your business. You want to create these, small relationships with buyers. And this is one of the reasons I started Acquire.com, where you can meet buyers all at once. So we take care of that aspect for you. But the way that I did it before was I looked up, private equity firms. I looked up strategic buyers and I kind of updated them on a quarterly basis. And when I was ready to sell, essentially I reached out to all of them at once and said, hey, we're looking to sell the business. And then from there, you're going to have, initial, conversations, really high level. Maybe Kjael's interested. So Kjael, me and you are just having a conversation. You're doing diligence on me. I'm kind of doing diligence on you as well. And you kind of get through, a period of, let's call it a month of calls, meetings, in person, virtually, much more on the virtual side now. It used to be in person. So a lot has changed in terms of, how easy it is to access buyers. But then you get to a certain point where ideally you've created interest with buyers where they're kind of leaning in, and that means they want to know more. They want to look in your data room, and maybe you create 2 levels of a data room where it's kind of like a teaser version, then you have a more detailed one. And what you're doing is your goal is to get buyers to initial offer, and that could be verbally, that can be what's called a IOI, indication of interest. So these are just like really high level offers. You can write it on a napkin, like, hey, Kale just offered me, $5 million for my business, and here's kind of the high level terms. Now, once you kind of feel like you've gotten to that point, that's where you're going to want to set forth what's called a deal schedule. So what that does is it tells all buyers that now you're on a timeline, because you don't want buyers to be wasting your time digging around. Kale, you made another good point of a buyer that just kind of asks a bunch of random questions all the time. You want to get to a point where it's a yes or no. Like, are we moving to the next step, or are you going to keep asking me random questions and not move forward? And that could also be a great way to weed out buyers. But a due diligence schedule will set the timeline towards a formal offer. So maybe in 2 weeks, I'm not taking any more calls. Or maybe there's buyers that you've reached out to. Maybe we can use Acquire.com as a reference, but maybe some have signed an NDA, but they haven't, scheduled a call with you. By July 1st, I'm no longer taking any more phone calls. And if you haven't got into the initial briefing call, then you're out of the process. Sorry. So that can move buyers and get them in motion if they were interested. Maybe they were looking at some of your, small data room items, and now that'll push them to meet with you. And then 2 weeks from there, that's when I want all IOIs, so any sort of indication of interest, initial offers. And then by August 1st, that's when I want to have the formal letter of intents coming in. And the importance of that, the last part specifically, am I getting like too technical here? How am I doing on this?
No, keep going. I
All
want
right.
us to be specific. So.
Got it. Okay. So the last part is the most important part, because a lot of founders think that it's good to have, maybe you get a LOI, letter of intent. This is, you sign it, you're moving into the due diligence, which I'll, speak on next. But you ideally want to have multiple letter of intents coming in around the same week, so you can essentially compare them against each other and negotiate against each other. So when that happens, you have leverage to negotiate on terms or price. So if you want a stock deal and not an asset sale, that's one of the best ways to have that leverage to be able to do that. If you want to ask for a higher valuation, you have another offer in hand, all things equal, you can say, hey, well, there's this other buyer who's interested. So you kind of get the idea. You want to create this perception with other buyers, or this environment where they know other buyers are involved and they are having to compete for the business. And if all that is done correctly, that's how you can get the best offer. Now it's time to close the offer. So you're unfortunately not done yet. That's actually kind of the easy part, is just getting the offer, getting someone. It's all hard actually, but getting someone to initiate or send you a letter of intent and actually want to move forward beyond that. That's a huge milestone. But getting that all the way to close and having the money in the bank, and that's a whole nother journey that you're going to go down. And that's where due diligence really starts. So you sign the letter of intent. Usually it's exclusive, meaning you're only working with one buyer now. So you pick this one firm, person, company, and you're probably going to spend anywhere from, some firms can do due diligence in a month, but typically you're looking at probably 2 to 4 months of due diligence, legal, and then closing. And so during that period, you're going to have, like Kale, said pretty accurately, the buyer is going to want to look at everything. They're going to have some crazy data requests, due diligence requests. You might want to meet your team. They might want to talk to your customers. So just be prepared. One of the best ways to prepare for that is before signing a letter of intent, just ask. Just say, hey, do you have a due diligence schedule or kind of an outline of what your process is going to be after I sign this? And that could really set you guys up for success, because you know what you're getting yourself into, so you don't have any huge surprises. And then it's just great to work with a buyer that has something planned out by week, ideally. So, when you sign a letter of intent, you can start due diligence off on the right foot. But in terms of, understanding, or getting past, the trust issues, or thinking that a buyer is going to steal all your stuff, I always like to say, if a buyer can look in a data room and copy your business and the success you've had, you haven't really built a durable business. Obviously, you don't want this information shared publicly, but at some point, if you sign a letter of intent, you want to sell your business, you are going to have to accept the fact that you are going to have to let someone read your code. They're going to have to, meet your team potentially. There are pieces that you can kind of hold back. And this is what I personally did and what I recommend. For example, meeting your team. There's nothing more disruptive to your business than a potential acquirer coming in, meeting your team, and deals fall through. So maybe you save that, part for the last. So there's certain things that you can, stage gate where you don't let them completely in, but if they ask, you're going to need to have a good response as to, is it appropriate time for that? How far along is it? If it's the first week after signing a letter of intent, maybe you can save it after you've gone through, high level financial, high level team, high level tech, through all the different departments, high level go to market. But you just need to accept that you have to share this information. Otherwise, the buyer will get red flags. They will see some sort of risk on the business. And again, the deal isn't done. So you need to continuously sell your business and get them excited about the business. So if you're continuously withholding information, that's just going to slow down the deal, which is going to give the buyer, reason to potentially back out of the deal. And then the LOI doesn't close, and then you're back at square one. So it's something that you just have to accept. And one of the best ways to get around that is do due diligence on the buyer. And so one way to do this is ask what other businesses they've acquired, and then call all those business owners and ask them, how did it go? Did they close on the letter of intent? Did they renegotiate on price as you were about to close? Was there anything bad that happened post-closing? Did they do everything they said they were going to do? If they haven't, conducted an acquisition or facilitated an acquisition, ask, who have you worked with in the past? Who can vouch for you? Because really what you're looking for is you're looking to see, is this person going to do what they said that they're going to do? Or are they going to waste my time and rummage through my business? Or say they're going to buy my business for, $10 million, and then they say, oh, I found something, and then say they only will pay 7 million. So just doing, background checks on the buyer too before you sign a letter of intent can, I think, really help with that. That's what I did. Personally, I remember calling like 10 of the different companies because they had them all on their website. Here's our portfolio of companies. So I remember calling the former CEO of all those companies. And sure enough, they were like, yep, they do exactly what they say. Yep. And that was actually the reason I went with the firm that I actually sold to. Because one of my biggest fears was signing a letter of intent and then going through this process and then the deal not closing. Because it's like having all your dreams dangling in front of you. And then it's like, no, I don't know if I could have recovered from that. So I did a lot of due diligence on the buyer. So when I signed the LOI, and I even asked them too, it's great to share your concerns with the buyer as well. I just said, hey, can you give me any assurances that this LOI is going to close? Because I'd like to do, you can do basically upfront due diligence where before I enter a formal agreement with you, can you just tell me where the red flags are going to be? What do you see throwing you off or scaring you away from this deal? And that for me was enough to be comfortable moving forward. So, doing what you can to build trust up front and due diligence with the buyer all the way.
I got a question from Rob regarding letter of intents. What should I be looking for to know if it's serious? And I remember, Kjael, we talked about this where you mentioned that you're careful with the LOIs that you send. So is there something, that people can consider when they're receiving an LOI to make sure that the buyer's serious? Maybe
Yeah, that's a great question. And I guess hopefully one of the big takeaways from Andrew's commentary just then is that it's a two-way street, this whole thing. Because so often the setup is I'm selling my business. I'm going to do whatever any buyer wants. And I'm going to run around like a crazy person because I'm going to try to sell my business. And it's like, this is a two-way street when you should expect them to want to speak to your customers at the tail end of this thing. Why don't you speak to whoever their customers are as well, which would be former businesses they've acquired, their investors, whoever. So definitely approach this. You're mutually dating, and it's a decision point on both of your sides to move forward. So with LOIs, and depending on who it is, but you might ask them, how many LOIs have you submitted in the last year? How many acquisitions have you made in the last year? or sort of put simply, for every LOI you submit, how many deals do you close, right? So you start to understand, what's the velocity? Because a lot of folks are like throwing LOI, because there are definite benefits, right? When you enter LOI, as Andrew commented, you get exclusivity. So that basically takes the deal off the market for 1 to 4 months or whatever the due diligence period is, and they can look at everything. And what you don't want, or another way, right, is just to kind of invert these questions that you've asked. Like, what do you not want if you're a seller? What you don't want is this endless exit process that takes a year, that occupies 20 to 50% of your time and is purely a distraction compared to operating the business and making it grow and making it more profitable, et cetera. So you don't want that to be dragged on, right? So if we zoom back, the first thing you want to do is understand the value of your business at any given point in time. So get the data room together so that you can look at it, have a relative point of view as to your performance to other comparable firms. Cool. I think our firm is worth, X or Y. Okay, great. And then you can move into these different stages where, you understand what the diligence process is going to look like, et cetera. But LOI, what you don't want is to have somebody sign an LOI that the first thing they do is like, oh, we like this deal, let's submit an LOI. And then what inevitably happens, and just so we're clear on the components of an LOI, it's non-binding, right? It's not legally binding. So it's like one of the loosest legal agreements there is. And it basically says, I'm going to pay you X, and here's how I'm going to pay you. So when we say terms, that's it, the payment terms. So this is the valuation, the purchase price, and these are the terms. And what is considered very shady is people that just throw out LOIs with below a 20% intent of making the acquisition. They just want exclusivity. They want to take it off the market. They want to look at everything and come up with their own opinions. The other worst case scenario is that they retrade on value. So they'll get to, and they can't rationalize it. They'll be like, hey, we said in the LOI, it's worth $10 million, but how's 8 sound? It's like, you just took 3 months of my time to get to this place and just, gave the valuation a 20% haircut. So I guess to ascertain the seller, it's really a function of like, prove to me with evidence that your LOIs are meaningful. And that's usually a function of how many of you submitted and how many of those that you submitted have you closed. I'd probably keep it to that. And then obviously proof of funds. Dear God, we didn't talk about that. So, and that can be an honest conversation, but like, how are you going to pay for this? And you need to feel good about, what their sources are. And if they can't have a transparent conversation around that, or you can't see something that makes you feel confident that they have the money to make the acquisition, do not go to LOI.
I think it's a great segue into the next question, which is valuation, but also the type of deal that you do you sign up for. So I'd like to continue with you, Kjael. When you approach potential target, can you tell us a bit about how you value that target, and maybe also with Andrew, how this may have changed over the years?
Yeah, for sure. So, and again, if we just continue to tie this through, so it's like you want to understand the attributes that influence evaluation. And as Andrew said, if we want to avoid this super drawn out process, you probably want to come in with some type of timeline in your mind. Month 1, we make a market for the thing. Then we gather explicit interest via IOI. We review our IOIs, then we commit to an LOI. We'll give somebody 3 months of diligence time to execute the acquisition. Under no circumstances is this going to take more than 6 months, right? So that's kind of where we would start. And then this is just how we get down, but valuation is subjective. So I'm always of the opinion, or what you don't want is a seller to just say, hey, I think the valuation is X. And then you ask them why. And again, everything is relative, right? So $1 million house is only $1 million because it has the same number of bedrooms and the same number of amenities as other homes in your neighborhood trading for $1 million. So you want to understand what attributes are you looking at to establish a relative point of view? And then what are the benchmarks that you're using? So for us, and actually I'll just pull up an example, right? So we look, and then obviously are the challenges of that. It's like, oh, how hard can it be? Just go on Zillow. The challenges are that a lot of this data is very opaque. So it's very, very hard. If you're, obviously playing in the publics, there's data galore, and you can come up with, okay, I think business value is really a function of these 3 things. These are our base rates. So what we look at are EBITDA margin, ARR growth, gross margin, and user retention. And so here are some benchmarks for that, which I've kind of consolidated. And again, this is where it blends a little bit towards art, but you look at comparables and benchmark reports from groups like acquire.com. Like if this is foreign territory to all of you, I would go into, maybe we can include that in the show notes, but like, the state of the industry, right? But figure on average, businesses selling, are doing for an EBITDA margin is about 67%. which is bananas, honestly. It's hard to believe. I would say it's probably like a 50% EBITDA margin or net operating income margin. ARR growth is 16.5%. Gross margin is almost at 90%. And then user retention is 97%. So it's as simple as that. If you want it to be, right? It's like, okay, here are these 5 attributes. These are the benchmarks. This is the business's relative performance, and then give it a score, 1 out of 4. 4 being outstanding, 1 being terrible. And then you're like, okay, this business is a 2.5 out of 4 on average across these dimensions. And so we know that on average businesses trade at this, it needs to trade at a discount. It's suboptimal performing relative to a peer group. But I think valuation's got to be something that's super transparent. And I'm always of the position where before you get to LOI, you have a very, very honest conversation with the seller. Like, hey, these are my data sources. This is what I looked at. This is how I inform these benchmarks. Because the other deal killer, and Andrew will laugh at this, but like we're all conditioned with like SaaS companies trading at 20 times, next 12 months revenue. And so a lot of SaaS founders are like, holy shit, my business, or sorry for the curse word. They're like, my business is worth $1 billion. And it's like, no, but they haven't done that work on the front end to understand their business performance on a relative basis to other peers. So I think it has to be the most transparent thing. And you want to get to a place where you yourself understand the valuation because, oh, by the way, 80% of deals break down. I mean, that's a made up number, but a bunch and a lot break down in the 11th hour. Like, you probably assume that the deal's going to break down, right? When you enter LOI. But at least coming out of that, you're like, okay, I know that these are the 5 levers I can pull to make my business more valuable. I can grow ARR. I can improve profit margin. I can improve our user retention. And so it'll give you a good path to creating enterprise value moving out of it. So, it's kind of that thing where, failure is the greatest teacher. So if you come out of a broken down process and you didn't learn anything that helps you improve the value of your business, then it was a failure. If you come out of it eyes wide, where it's like, hey, we took 6 months, we adhered to our timeline, we didn't get a deal done. We know that our focus next fiscal year is to grow or is to get a 20% year over year growth rate. And then we're going to go back at it and we're going to refine our process and we're going to.
Andrew, I know that Acquired.com, your team helps, sellers with a different bunch of things. And I'm assuming valuation might be one of them where, you're giving them some pointers. Like what are the typical issues that you observe?
Yeah, Kjael hit on a lot of great points. I would say I want to start with one thing that you said, Kjael. And it's true. I did it too. I used to just take my revenue and multiply by 10, and that was my imaginary net worth. It felt great. It wasn't true though. In some extraordinary cases, you will sell, someone watching this, you will sell your business for 10 times revenue. But for the majority of us, unfortunately, that will not happen. I don't know who made up that number, but shout out to them. The first thing, that comes to mind that really messes up acquisitions really is valuation. It's when sellers or founders, entrepreneurs, they price their business too high. Just like think about you're selling a home. When you price a home too high relative to the other homes around it, no one's going to come to the open house. No one's going to look at the house. No one's going to look at the listing. And so you never even get an opportunity to talk to buyers. So they're never going to stop by, have questions, and show any sort of interest. And that can really shrink your buyer pool, which again shrinks the amount of potential offers you're going to make, and definitely lowers the potential outcome. So it's kind of a reverse of what a lot of entrepreneurs I work with think. They think, let's start with a really high price, and that means buyers will only talk to us, or only the buyers that we want to will talk to us. But in reality, what happens is it backfires and no buyer talks to you. And your goal should be to create this competitive environment where you can negotiate upwards in price. But the metrics that we look at are the same ones that buyers look at. We look at annual recurring revenue. What is your growth rate? What is your profit margin? How is churn looking? And then how many customers you have? What type of industry are you in? Are you in an SMB market, mid market, enterprise? Is the business in an interesting vertical that we're seeing a lot of traction in? There's a lot of, kind of art and science that goes into evaluation. There is kind of the scientific part, like Kjael mentioned, where, we do have a ton of comparables and we do have a ton of data on these types of businesses, but every business is unique. A house really is a house. Like my neighbor's house is very similar to mine. It's probably going to sell for a similar price if I was to sell my house. But a business, it's going to have different, the team, the quality of the software, the quality of the customers, the potential upside in the business. Is there, certain go-to-market channels they haven't stood up? So there's, really clear opportunity for a new buyer to come in and continue growing the business. But all things equal, it's pretty easy to put a fair valuation to your business. And the biggest piece of advice I have there is get multiple opinions. And we say this at acquire.com all the time, is when we give a valuation, we say, don't just take our word for it. Like, go get like 2 other evaluations if, you don't think this is in your ballpark or in your range. And then we can apply that too. So we also, get other opinions all the time as well. But ours usually will come in right around where, the fair value of the business is. So if I was an entrepreneur, kind of the long piece of advice here is, ask multiple, you can ask potential buyers like private equity firms for valuation. Sometimes if they're a buyer of your business, they'll give you a ballpark range. You can talk to an investment bank, a business broker, or companies like mine, acquire.com, and we can give you a valuation. So you have multiple different data points to reference.
Just on this, got a question from Sarah about negotiations. Do you have any key strategies that you can share to help during the negotiation process?
Oh, can I take this one?
Yeah, is she on the buy side of this? Well, I guess, yeah, cool. If you got it, yeah, go for it.
I'm going to assume you're on the sell side. And if that's you, I would say just draw a line in the sand. And what I mean by that is the person who wins the negotiation is the person who cares the least. So what that means is if you have a set price where you will not sell your business for less than, let's go with a nice round $10 million. If someone offers you less than that, you need to be willing to walk away. And if you really are willing to walk away, you're willing to just say, no deal, this is my set number. That's how you get someone else to budge on, where they may be at. Maybe it doesn't work out all the time, but that's typically the best way to negotiate, in my opinion, is, write down specifically what you want. And it needs to be within reason. You can't just say, I want revenue times 10. And that's probably not going to work out as a negotiating piece, but you need to be able to walk away if, whatever you're trying to negotiate, whether that's terms or price, isn't met, and that buyer you're just not going to work with altogether.
Totally. And I think what's interesting too is like, it's a capitalist society. So we assume it's all about the money, but don't assume it's all about the money. Like, assume that this is that person's baby and that they deeply care for their customers. They deeply care for their contractors and their employees. So a key component of negotiation is to make it about more than just valuation. So it's like, what are the most important outcomes to you? You might hear sometimes where it's like, well, I'd like to kind of stay involved in the business. Like, I'd like to be an advisor. I'd like to sit on the board. I'd like to maintain 5% equity, or I need straight cash, homie. It's like, okay.
Yeah.
So the deal that I was about to structure, which is like a 30% earnout or a 30% seller note or whatever, that's non-negotiable. So think, okay, I have a reserve price if we use like negotiation speak, which is my floor. And then as Andrew Gazdecki, as we've all spoken about, just make sure it's a rational number or that you can feel good about defending that valuation, because then you'll be closing doors before they're even open. It's like, here's my reserve price. And here are the 5 outcomes, keep it simple. Here are the 3 outcomes in a new home for my business that are the most important. I want my customers taken care of. I want my team taken care of. Because you have to, and then that's also a piece too, where you can lean in a little bit to what is the value creation strategy. And if you care about team, they're like, cool, we're going to fire everyone and offshore all the labor. It's like, oh my gosh, they're going to pay me more, but this knocks out my 2 or 3 most important outcomes for the exit. So just be clear that valuation is one attribute, one lever in the negotiation, but you yourself, whether on either side, on the buy side, you need to be clear on what the transformation plan is, very loosely speaking. On the sell side, you need to be very clear on what's important to you besides dollars and cents.
But you've talked about stock sales or stock deals or asset sales. Is there like a deal construct that is more favorable for the seller versus the buyer? Maybe Andrew?
Yeah, stock sales always way more favorable for the owner of the business. And the main reason is tax purposes. And to give a little more detail behind that. So a stock sale is typically pretty rare. And the reason for that is a buyer assumes a ton of responsibility. So if you ever gave shares to your friend or something like that, and they come back and say, hey, I own this business, stock sale is gonna, be trouble for the buyer. Or there's someone looking to sue as soon as you sell. That's gonna be trouble for the buyer. So what an asset sale essentially is you're going to take your existing corporation, whether it's a C Corp, LLC, you're going to dissolve that entity, and the buyer is going to purchase all the assets and move them over to a new corporate entity, a clean one, a brand new one. It doesn't have any, 5-year-old cobwebs, just things you don't know about. Most sellers, you don't think these things will happen, but as a buyer, why take on the risk if you don't have to? That's generally why you see more asset purchases, especially if your business is worth 10 million or less. And then in a stock sale, you're going to be taxed much differently. In an asset sale, you're typically taxed as ordinary income. And in a stock sale, you're going to have long-term capital gains. And you can also benefit from things such as, definitely Google this. Google QSBS. It's a tax exemption if you hold stock in a business for more than 5 years. There's some other details on that, but let's say you have a C Corp and you hold the stock in that business and you're acquired in a stock transaction, you can actually have 0% capital gains up to the first 10 million, and then it's long-term capital gains after that. And I believe it's just recently changed where it's 10% or something like that. But again, it's much lower than typical long-term capital gains. So much more favorable for the seller.
Like a very simple way to think about it, right? Is that an asset sale is just the assets. A stock purchase is the assets and the liabilities. And so buyers obviously get very cagey because it's way more difficult to like pinpoint what the liabilities are. But if you have debt on the business, they don't want to acquire, they don't want to, I guess, take over the debt payment, et cetera. So probably assume that it's going to be an asset purchase if you're playing in the lower middle market. And the tax treatment is obviously the big one. But no one wants to buy liabilities. Put simply.
Yeah. And maybe one thing to add there too is a stock sale and an asset sale, I've seen them on the lower end, and it's always when you create that competitive process. And like Kjael mentioned, it's not just all about price, because you can sell your business for, I'll use 10 million again as an asset sale or a stock sale, but in a stock sale, you're going to, see much more cash. Because you don't have to pay taxes on whatever you receive. So that could be a negotiating chip potentially if you're going to need multiple buyers in play most of the time. Where you say, hey, one buyer offered me this, but if you're able to, conduct a stock sale, that's going to be very beneficial to me, and I would agree to that. So again, it's not always about just the final number. Terms are just as important as price sometimes.
One quick thing too, just to chime into 2 seconds, is also everyone's like an asset purchase of a software company. It's like, what are you going to buy? Like the laptops from the engineers? Like there are no hard assets. So just to simply think you're buying the code base, you're buying the web domain, you're buying the social media handles, you're buying the customer list, the customer contracts. So when you start to, I guess the soft assets are what SaaS is all about. But sometimes people are like, they're not buying a widget factory. So anyway.
Yeah.
I'm just looking at the time that's running. One of the things I want to talk about is post-acquisition. I've seen a lot of, there's probably a number somewhere on the internet that says like 85% of acquisitions don't generate the synergies that were expected or the incrementality that they were supposed to bring. There's a lot of problems that comes after the acquisition. So I'd like maybe Kjael start with you. Especially since, you're putting so much effort into acquiring a company. What are the key things that, have to be, you're able to tick the box to have a higher level of confidence in terms of success post-acquisition?
Yeah, for sure. So one really important caveat is that data point is related to M&A, which is I'm a business, I'm going to acquire a smaller business and we're going to integrate it into our operation. That is very difficult. So the failure, like simply put, this product is written in this code language. This this is written in English. This is written in Greek. Cool. We'll just smush them together. How hard can it be? Very, very hard. And then you have cultural context. There's all kinds of stuff. So if you're acquiring and integrating businesses, which is kind of like a roll-up strategy, the failure rate is much, much higher. In our world, we're acquiring businesses and letting them, or generally speaking, continue to operate autonomously as their own thing. You don't smush them under a new brand. You don't change a lot of the stuff optically. So the success rate should be much higher, but your number one job is to not rock the boat. So this is where the conversation comes into like a seller transition period. which is another part of the negotiation. But we always ask for at least 3 months of seller transition, and that's on a sliding scale. So figure month 1 after the sale, you're contributing 40 hours a week. And it's like, hey, you're just showing them the ropes. You can shadow me for a day. I'll maybe document some of the product stuff or document some other stuff and kind of help you get the data, or to a degree, you could call that data, in order. But there's a seller transition period. And I think for me, especially, like if I look back on our first acquisition, and that could be a 10-hour Zoom hang, but like the first thing you want to do is observe and document. And your job is to transfer as much tribal knowledge in the seller's head and in the team's head into something that's codified that you can use on a go-forward basis and reference on a go-forward basis. Your job is not to get in there and start changing stuff. So, I mean, you can if you've got the courage, but so I think seller transition, and your job is to make sure the ship stays on the same, trains are on time and there's no real disruption to the business. And that's usually a function of getting visibility where you need it, documenting areas that could use some improved documentation, because that's a ticking clock, right? So figure if it's a 3-month seller transition, that first month is maybe 40 hours a week. That second month is 20 hours a week. That third month is 10 hours for the whole month, right? And so they're going to leave at some point. And then when that breakup happens, it gets real. But your job is to keep the trains on time, full stop. And also you can use that time to validate whatever your investment thesis was coming in. So it's like, hey, we think that we can do this to create growth. Okay, let's really lean into this. Do we have a good grasp on the customer segments? Do we have a good grasp on what the value prop is and the jobs to be done, et cetera? So you can use that as kind of a validate and observe and validate. And I have a much more well-spoken and articulated version, but we think about it as like the first 100 days. And that's kind of like a document, observe, and just codify, but you're not changing anything.
And what about you, Andrew, on the maybe the seller side? Whenever a buyer comes in with a specific earnout period, like what should the seller be looking for?
I think Kjael hit it on the head. I typically always see some sort of seller transition period around 3 months. I actually recommend it too. Like one thing that you can do as a seller because when you're selling your business, you want to reduce the risk for buyers as much as you can. But one huge risk is you just leaving on day one, or there's some parts of the business the buyer doesn't know and they acquire the business and you're nowhere to be found. So making the transition as seamless and easy for the buyer, and having that outlined upfront, even before you get to formal offers, like at the beginning, letting buyers know, you're open to seeing this buyer smoothly transition to a new owner. You're going to help with everything. That can make all the difference in terms of getting buyers excited enough to submit an offer. And then, when the business or the acquisition closes, I would definitely expect to have 3 months minimum, depending on the complexity of your business. If you have, employees and offices all over the world, it might be a little bit longer. Or if you agree to an earnout or something like that, where you want to influence the outcome or the targets that have been set over the next year. So an earnout is typically going to be based on some sort of revenue goal or growth rate. Sometimes it's just maintaining the business, so ensuring it doesn't decline. So in those scenarios, typically you'll be working with the business for a longer period instead of not having influence. You're going to want to be in the business. But at the minimum, I'd expect to, be in the business for, 3, 4, 5, 6 months, depending on the complexity, to help ensure that it continues to, operate well without you.
I got one last question from Mark. I'm thinking about making my first acquisition. What type of teams do you recommend building? Or maybe that's for you, Kjael. Like I guess that's something that's super relevant also on the seller side. Well, we know what kind of team they should be looking for.
Yeah. So I think the first thing is like, what's your edge? And the simple way to bucket yourself is I'm either a product technical person or I'm a sales and go-to-market person. And then, so let's just use my context. Like I can read code, but I'm like a 3 out of 10. So like when I think about the people I need at the table, and if we just bucket diligence areas, I need, and depending on the scale and the complexity of the revenue side, but you probably need an accountant to do what's called quality of earnings. So they're going to basically make sure that the revenue and that everything in the P&L makes sense. So you need an accountant to look through the books. You need a lawyer to draft all these contracts and to look at contracts if that's relevant. And then you need a technical partner to audit the code base. And that's about as simple as it gets. If you are auditing the code base, then maybe you leverage someone like me, who's like a fractional CRO human, to look at what their acquisition channels are, what their metrics look like. And again, you're just trying to build conviction around whatever area, of your thesis is like the most fuzzy. And then this is also very important in terms of sequencing, like your job in diligence is to find red flags, because diligence costs money and it costs time. Do you want to be like, there are these 3 things that are deal breakers? Cool. You need to invest in that first and then resolve those red flags before you carry on through diligence. So if you're very concerned about the code base, it's very, in legacy code stack or whatever, maybe start with technical and you bring in a partner and you're like, it's going to cost me $3 to $5 grand for a technical diligence partner to go through this, but I need to feel confident to continue investing and continue exploring this acquisition. So just make sure that you have like an order of operations or a sequence of priorities of what you need to do diligence around, and then, fill the table with the experts that you don't have or that aren't between your ears.
And those folks are in-house for you, Kjael, or it's kind of an extended team that you bring in whenever needed?
Yeah, you're looking at the in-house right now. No. And that's, people need recommendations or whatever, shoot me an email, but you're going to want a good lawyer, because there's legalese involved in all this. And there's, Acquire has really useful stuff for like LOI, but I would say anything beyond like once you start crafting an asset purchase agreement, it starts to get hairy. If you need to actually look at the, employment contracts, stuff like that. So you need a good lawyer, and you need somebody super competent on the code base side. And then for Q of E with an accountant, like, this is not like a warehouse with accounts receivable and working capital and inventory, and you don't have to value all that weird stuff. It's like revenue comes from Stripe. There it is, right? So you can maybe save on that, but eventually you'll need a bookkeeper and somebody to help you, with the entity structuring and all that other stuff. But
on the seller side, Andrew, quickly, I think you mentioned that.
VP of finance, you're definitely going to want a really good attorney. Those are, the 2 that are like must-haves. And then obviously when you go into due diligence, you want to probably, spread it across your team. But the 2 that you're definitely going to need is someone who can help, supply the data. So that could be you, maybe you're a finance whiz, or maybe you got a system set up and everything is super, super clear to a buyer. You're definitely going to need a really, really good attorney.
Great. I don't want to take too much of your time. I think we've an hour and a half was more than enough. Any parting words before I let you go, Andrew?
I would just say, again, to any, entrepreneur out there looking to sell their business, kind of a shameless plug, but if you're thinking about an acquisition, check out acquire.com. And if I had any, parting words of advice, is just, prepare early, figure out what the strategy and the plan is going to be, and then go out and execute it.
Yeah, I guess I'll speak for the other side. This is an extraordinary path in life where you really get to kind of do what I think is the perfect intersection of venture and private equity and entrepreneurship, where you can kind of de-risk all these things. You can step in and operate a business. You can bring your own people in to do it. You can generate interesting earnings to kind of cover your bills in the interim, while also, investing in an asset and making the asset more valuable. So you have a chance at, kind of interesting generational wealth. So if you're considering acquisition entrepreneurship, or if you're burnt out from being a venture operator and being told to grow the business 100% year over year, or you're tired of working with private equity funds that kind of capture all the value creation because they brought the capital to the deal, search entrepreneurship is super, super, super interesting. And I've been building in public. I'm kind of doing it for myself a year ago. I'm like, man, I wish I had somebody who was like a year or 2 ahead of me to just write out loud and kind of learn out loud. So if you're interested in this at all, I have a Substack at Scaling Ventures. And I would say too, once you list on Acquire, because I don't want to short circuit that, but hit me up. I'm here to be a resource for the founders. If you're like, hey, how the hell do I value this business, or what's the hair on this, or what can I do to make my business more valuable before we go to market and pursue an exit, I'm here to swap notes. I love that stuff. For me, this is all the game that I chose. So I think about it when I'm sleeping.
Well, Andrew, Kjael, thank you so much for your time. Thanks to the audience as well. If we didn't have time to answer your question, or if you think about something else afterwards, just shoot me an email, michel.gagnon@stanena.com. And guys, thanks a lot again. Have a good rest of the day.
Thanks for having us. Good to chop it up with you, Andrew. Michel, thank you.
Yeah. Great seeing
Well
you guys.
done. Awesome.
Cheers.
Cheers.
Cheers.